is very shocking. More and more venture capitalists and investors now prefer the debt model compared to the equity model. And well, that may seem like a good thing, especially because as a founder, you don't get diluted when you get debt, when you get outside capital through the debt model. The truth is that this is a negative indicator. Ideally, investors are supposed to invest in a business or in a startup and be in it for the long haul, because their goal, ideally, is to get capital gains. Their goal is not usually to get interest on their principal. But now that they're switching to this debt model, that is exactly what it is becoming. And here is the cause of that problem. Here is the root of that problem. You know, our market has an entry for capital, an entry for investment, but not so much for the exit. So what has happened over very many years in our market is that investors are able usually put in money into businesses, but then there's no defined exit event for them to pull out their money. And the same thing applies to entrepreneurs. You build a business for 2, 3, 4, 5, 10 years, but then there's no way for you to get out of the business. In other markets, an exit event is something like listing in the stock market. But in Kenya, how many companies have you had listing on the stock market besides, you know, the two that listed, Family Bank and KPC, in the last maybe 3 years? I can't even tell you. So it's a negative indicator. Switching to the debt model is not necessarily a solution. The long-term solution would be, you know, switching our gaze from the fundraising bit to the exit bit, fixing the exit bit. And that means making sure that our secondary markets are active, making sure that the space of mergers and acquisitions is very active, and it can be a very rewarding space. And that is exactly what we do at Exit Bridge. Our company is literally called Exit Bridge 67 Limited. We help entrepreneurs and investors to exit, whether it is sweat equity or capital equity, from businesses. And we do that in a very simple way. We have a deal origination platform that is called Buy Biashara, where we usually list these businesses anonymously and these investments anonymously. And that allows other entrepreneurs and other investors to be able to browse these listings and evaluate whether they meet the criteria for the businesses and the investment opportunities that they are looking for. And therefore, we're able to match the market. We're able to somewhat spur the secondary markets. So don't think for a moment that investors preferring the debt model to the equity model is a good thing. It's actually a negative indicator.